As an introduction to Chapter 10, Plant Asset Accounting, there are many terms in this chapter. Looking at the key terms at the back of your chapter, I'm going to point out the key terms. I'm not going to go through them all. That's what your textbook is for. We're dealing with plant assets. What are plant assets? They're long-lived, tangible assets used in the business operation to make goods, generate profit, and they're not intended for sale, unlike inventory, which is bought for everyday sale. So, long-lived, intangible, used in the operations, not intended for sale. Looking at it on a classified balance sheet in Chapter 4, you can see plant assets are not a current asset. Okay, current assets are cash, things turned into cash. Plant assets are used in the business. Land, building, equipment, used day to day to generate either making a product or providing facilities to sell inventory. Again, they're not intended for day-to-day sale. Depreciation is a very key term in this chapter. There are different methods of depreciation, such as the straight line method, the double declining method, and the units of production method. Book value, an important term. Cost principle. All plant assets are, when they're acquired, they're booked at cost. And depreciable cost is a very important term. Let's go back and review what depreciation is. It's an allocation of a plant asset's cost over its useful life. What's it based on? Obviously its cost, estimated useful life, and estimated residual value. What's a residual value? It's the value expected of that asset when a company is done using it at the end of its useful life. Take two quick examples. Asset 1 and Asset 2. They both cost $200,000 at acquisition. Asset 1, after its useful life, and let's say it's a 5-year useful life, is expected to have a value of $20,000. So $200,000 less $20,000, $180,000 is its depreciable cost. That will be depreciated over 5 years. Asset 2, let's say a same $200,000 cost, and its estimated residual value is 0 after it's used, and its depreciable cost would be $200,000. So in these two cases, two different assets, similar cost, but different residual value, both depreciated, let's say, over 5 years. And let's take the straight line method, which is the most commonly used. Each year, asset number 1 will be depreciated $36,000. $180,000 depreciable cost divided by 5 years, $36,000 per year. Asset 2, depreciable cost of $200,000 for 5 years. Would be $40,000 per year. Again, depreciation is a function of the cost of an asset, any estimated residual value, which could be 0, and its useful life. Cost, any estimated value when it's finished being used over its life, and allocated over its cost of life. The straight line method is the most popular form, very simple. Depreciable cost divided by number of years, $36,000 per year for 5 years. Depreciation complete. Asset 2, 5 years, $40,000 a year, depreciation complete after 5 years. Brief comment on book value. Book value is original cost of a plant asset less any accumulated depreciation to date is its book value. Back to the balance sheet in Chapter 4, the book value of buildings is its original cost of $60,000 less $250 depreciation to date. Its book cost is $59,750. Book value is not the same thing as depreciable costs. Be sure to distinguish it. Now there are different methods of depreciation expense. Just taking a straight line example here for asset 1. First year's depreciation, $36,000 per year. Full year's depreciation will be recorded as such. Depreciation expense, an expense account on the income statement. Accumulated depreciation is a contra asset in the balance sheet. That contra asset account sits underneath its associated asset and accumulates depreciation throughout the life of the asset. Contra asset account. The 4 types of plant assets discussed in this chapter: land, land improvements, buildings, and equipment. Land is not depreciated. It's assumed not to lose value. That's why land improvements are a separate category. Land improvements would be putting a fencing around a property, or some shrubbery purchased, or a parking lot put on land. Those all have limited lives and are depreciated. Likewise, buildings and equipment are depreciated over their useful life. The term used to depreciate plant assets, depreciation, if it's a natural resource like a coal mine, same concept, but we call it depletion. I mentioned the cost principle. Plant assets, when they're acquired, they're recorded at cost. What can cost include? Here's an example, handout in Momentum. If the company is purchasing land, it can include the base purchase price, any sales taxes or permits that are required in buying the land. Any broker's commission that's paid to a broker acquiring land is capitalized as part of the land cost. Any title fees, research by an attorney, any surveying fees. I'll come back to that one. If there's removing of a building, an old building that's not meant to be used, that is capitalized as part of the land because it's what it takes to put that land in usable condition. Any clearing or grading of it. We'll go back to real estate taxes. Delinquent real estate taxes. If the previous owner did not pay his real estate taxes and the buyer wants that land and agrees to pay those delinquent property taxes, they become part of the capitalized cost of the land. Next year, ongoing real estate taxes are not delinquent, are expensed each year. But if it's delinquent upon its sale and the new buyer agrees to pay it, it's part of the cost of the land. It's what it takes to acquire that land and get it ready for its intended use. Buildings, basic construction costs, and the architectural fees, engineering fees, excavation fees are all capitalized as part of the building cost. If it's a constructed by a company in a long-term project, interest and taxes during the construction period are capitalized. Beyond the construction period, they're expensed. Any sales taxes and insurance during the construction period would be capitalized. Any permits would also be capitalized. Likewise, machinery equipment, base purchase price, any freight, and any taxes if applicable. The installation of equipment would be capitalized as part of its depreciable cost. Assembly, testing for use, permits, all part of the capitalization cost. Land improvements, again, this is a separate category apart from land, because land is assumed not to decrease in value, so therefore it is not depreciated. It stays on the balance sheet until it's sold. Land improvements, though, such as shrubbery or fences or lighting or paved areas, these are depreciated because they have a limited life. Brief comment on some of the methods. The three methods that are discussed: the straight line method, double declining balance, units of production method. The straight line method is the most popular, easiest to calculate. Simply the original cost of the asset less any salvage value, which could be zero, divided by the estimated service life gives the annual depreciation expense. In the previous example, I used $36,000 as the annual depreciation expense. Companies will typically record that each month. So every month, $3,000 this entry. Debit depreciation expense, credit accumulated depreciation. This is the annual amount for the previous asset I showed as an example. Going back to that previous example, asset 1 with $180,000 depreciable cost, 5 years, $36,000 per year, obtained by taking 1/5 of the depreciable cost, or we can express it as 20%. So we could say 20% of the depreciable cost the annual depreciation expense. This is important when we look at the second method, double declining balance. The double declining method of recording depreciation is the most complex one in this chapter. It takes a book value times a constant rate per year. What is that constant rate per year? The DDB method, the first D stands for doubling the straight line rate. So in that previous example of a 5-year asset, the straight line rate is 20% a year. DDB would end up taking that 20% rate times 2 and using 40% every year. Multiplying it times what? The declining book balance. That rate times declining book balance gives depreciation expense for the DDB method. Again, this is the most complex method in the chapter. Short example in my Momentum handout notes using the DDB method. Let's assume an asset costs $100,000 and had a 4-year life with a $10,000 salvage value. So how do we calculate the first year depreciation expense under the DDB method? First of all, what's the original book value? $100,000. What's the rate we use? A 4-year asset, the straight line rate is 25% times 2. 50% is the rate we use every year in the DDB method. So 50% times $100,000, there's depreciation expense of the first year. Second year, same rate. What's the declining balance? Original book value, $100,000, less 50 is 150. I'm sorry, $50,000. $50,000 book value at the beginning of year 2 times 50%, $25,000 depreciation expense year 2. Year 3, what's the book value? $100,000 less 2 years of depreciation expense, $25,000 times 50%, $12,500. This is just the accumulated depreciation per year added up. $50,000, 50 plus 25, 75, 75 plus 12, 5, 87,500. So the question in this problem, what's depreciation expense in the last year under the DDB method? We force it. It's $2,500. Why? We didn't take into account salvage value the first 3 years. It's always based on the declining book value. But in the end, we can't depreciate it beyond its depreciable cost. Depreciable cost, $100,000 less $10,000. Salvage value. Value expected of the asset when we're done using it after 4 years. So the depreciable cost is $90,000. So our total depreciation cumulative has to be $90,000. We simply force the last year's depreciation expense. We know this has to be the total depreciation over 4 years. This is what was taken cumulatively through 3 years. The difference is the 4th year depreciation forced. It's this 4th year that takes into account the salvage value. Up to that point, we don't look at that until the last year under the DDB method, because we cannot depreciate more than its depreciable cost of $90,000 based on this assumption. The chapter also calls this residual value, salvage value, same thing. Terms of residual value, salvage value, interchangeable. Of the 3 methods of calculating depreciation expense in this chapter, the straight line method, the easiest, double declining balance, the most complex. Both of these are time-based, depreciated over its useful life. Use of production is not time-based, but it's based on usage of the plant asset. That is, its full production capacity. We're talking about output. Give a short example of this units of production. Again, not time-based, but based on actual usage of the asset. Going back to our $100,000 4-year life, $10,000 salvage value asset, we don't use the useful life per se. Original cost, salvage value or residual value, $90,000 depreciable base. And if over that lifetime the asset, let's say it was going to output 25,000 units, we divide that into our depreciable cost and get $3.60 per unit of depreciation per year, per unit of output. So from the first year, we produce 5,000 units off that machine. We multiply it times 360. And we record $18,000 of depreciation expense in that year that we made those 5,000 units. So the depreciation expense per year can vary based on how much was produced in the year. It could go up and down based on units of production times that per unit calculation after taking into account salvage value and lifetime output. Usage based, not time based. The three methods in this chapter, this is the one that will is the most complex because it does not take into account salvage value until the last year. Double the book value, declining book value throughout the asset's life.